Hello, I am Callum Thomas, Head of Research and founder of Top Down Charts, and I'm going to take you through a topic from one of my recent reports here. The topic title there is CMA plus ERP. A bit of acronym action going on there. What that is capital market assumptions and equity risk premium. And we'll go through some specifics here around what those mean. We'll just sort of assume some average knowledge, but anyway. So yes, capital market assumptions. What are they? Well, they're basically inputs that asset allocators would use to either perform some sort of mean variance optimization, basically to build some sort of strategic either benchmark or actual allocation. Really, it's something that they use to sort of form a quantitative basis for building up, some basis for making allocations, really, and particularly over the longer term. If I tell you what the time frame is for these, it's basically a 5 to 10 year period. Why 5 to 10? It means basically longer than 5 years, but not super long term, as in 10 years, 20 years, 30 years. You know, which it's the projection forecast quality over that time might be questionable. Anyway, so what we've got here is basically expected returns. So there's a few different things in capital market assumptions, but really the main thing is expected returns. And I'm not going to go into detail, but basically building that up from yield, any growth, and then any valuation adjustment and any hedging premium. Good time to sort of move into the next one there, and global equities. We can see there the breakdown of those things that I mentioned across the different buckets or sort of categories of global equities. So you can see the US equities got a substantial expected headwind from valuation adjustment, and and that's just based on where valuations are at the moment. Kind of expects some mean reversion over the longer term. I try to make these forecasts, assumptions, predictions, whatever you want to call them. I try to make them as quantitative as possible. And there's always going to be some element of judgment because is even with the most quantitative approach, there's some sort of implicit judgments around the way that you treat the transformation and combination of those quantitative inputs. But anyway, here is basically assuming that valuations revert to a mean over some time, 5 year period is what I put there. And what that would result in, it would be a significant valuation headwind for US equities there. Now, we can always debate the level of these red dots, where the specific level should be, but one thing that I always keep coming back to on capital market assumptions, personally, I just think it's almost more important to look at the relative levels. So, for example, US versus global ex-US, developed and emerging markets, frontier versus emerging markets. So that's one thing, but then the other thing is looking at it across time. And so you can see here in the left chart, I only started calculating these back at the beginning of 2019, so we're starting to get a bit of history there. And on the history, we'll go into a particularly interesting chart in a second. But I also wanted to point out, back on the relativities, if you look across all the asset classes that I calculated for, you also notice the relativities of equities versus bonds, for instance. And that is where in my view, the latest outputs, so this is for August, get particularly interesting. And now I guess we're in kind of a day and age where these, the movements in markets can make things change pretty drastically over the course of a week. This report was put out a couple of weeks ago, so definitely has aged since then, given the market action. But even with that market action, it wouldn't have actually strayed that far. And what I'm warming you up to is the idea of the prospective equity risk premium here. So it did actually. So if you look back on that down there and you see US large cap equities almost minus 5%, expected return, whereas US Treasuries, and this is in nominal terms, is positive, barely, but still positive. And so that gives you the result of a negative, and quite substantially negative, prospective equity risk premium. So, yeah, equity risk premium is basically the compensation that you demand, receive, expect over and above the risk-free rate in exchange for taking on equity risk. And yeah, so this chart is showing you the forward-looking equity risk premium. So if these capital market assumptions turned out to be absolutely correct, then you would end up with very much not being compensated for taking on equity risk premium. You'd actually be punished for taking on equity risk over treasuries. But with treasuries expected to earn next to nothing, and that's not even factoring in inflation, then it's kind of a very poor choice set if that's the only two assets that you're looking at. But anyway, why I wanted to highlight this was one reason that I got, one reason amongst many, because there was a whole confluence of charts and information and reasoning that led me to get bullish in March. But one was seeing that prospective forward-looking equity risk premium go from -2 to +8. Hefty, chunky move there. And now it's actually gone from +8 to -5. Quite a big move there as well. And I think that, while I'm constructive over the medium term, especially, but, actually more on global ex-US, which, if you look at this global equities chart, then you probably understand why. So I'm constructive over the medium term, but then, you look at the way that the forward-looking equity risk premium is sitting for US equities, it definitely puts the move of the recent weeks into context. And yeah, I mean, these are not supposed to be tactical timing indicators, but then, you know, with the benefit of hindsight, that negative expected equity risk premium back at the start of the year, of course, it was met with a bunch of catalysts, but that actually skewed the risk to the downside on the short term as well as the long term. And I mean, I would emphasize again that these are designed for making longer term decisions, but when you see it move like this and get to these kind of levels, it can actually have tactical implications as well. So with that, I guess I'll close out, and the way to wrap this up would be the long-term and tactical considerations of capital market assumptions and the prospective equity risk premium. Now, in closing out, I will just jump to the front page. So what actually is this report that we're looking at? It's called the Weekly Macro Themes. I put this out on Friday afternoon / Friday night New Zealand time. Cover 5 different ideas each week, from sort of macro issues. You can see the global monetary policy pulse to specific ideas there. Covered some interesting stuff on dividend futures in this report. And then, some general research insights can be covering investment ideas, risk management input, which, that last one was a pretty good example of that. So if you want to have a look at this, it's only available for institutional investors, so I would note that. But yeah, definitely get in touch and I can set you up with a free trial. www.topdowncharts.com